Welcome back to the Deep Dive. We are looking at a turnaround story today that, frankly, sort of defies the usual gravity of legacy finance. It's talking about Charles Schwab. And if you've been tracking the headlines since, way back in 2023, you know the narrative.
Oh, yeah. The cash sorting, the balance sheet holes, interest rate headwinds. It was the crisis narrative that just wouldn't go away.
Right. There was this genuine, persistent question in the market of whether the old guard, so to speak, could pivot fast enough to survive.
The assumption was just that they were too heavy, too slow, and way too exposed to what the Fed was doing.
Well, we have the fresh Q4 2025 earnings report right here. It just dropped today, Wednesday, January 21st, 2026, along with the executive transcript and the slide deck.
And looking at these numbers,
That crisis narrative isn't just dead. It's been buried under a mountain of new assets.
it really has. Schwab didn't just stabilize. It looks like they built an entirely new growth engine while everyone was just watching the interest rate charts.
So let's start with the headline number that really anchors this whole discussion. The mission for this deep dive is to figure out how they pull this off. Because for the full year 2025, Schwab brought in $519 billion in core net new assets.
Over $500 billion.
In fresh money.
Yeah.
In 1 year. That is a 42% acceleration over the previous year.
Just to put that in perspective for you, that inflow alone is larger than the total assets of many, many mid-sized brokerages combined.
It's a staggering figure. And it tells you that despite all the noise about cash sorting or, the tech integration issues with Ameritrade, the trust in the brand.
It never actually wavered. If anything, it seems to have accelerated.
So we have the massive inflows. Now we need to dismantle the how. We've got the financials, some surprising demographic shifts, and this really interesting trifecta strategy.
Right.
Let's start with what their CEO, Rick Wurster, calls the brilliant basics, the financial turnaround. Because looking at this profit jump, something fundamental seems to have changed in their operating model.
Yeah, you have to look at the profitability metrics first. Adjusted earnings per share. It hit a record $4.87 for 2025.
Which is 50% growth over 2024.
50%.
Yeah.
For a company that's managing nearly $12 trillion in assets, that's rare.
Revenue also hit a record $23.9 billion. But the real story, I think, is in the margins. A year or two ago, the big fear was this supplemental funding issue. Walk us through how they fixed that hole in the balance sheet, because that was the anchor dragging them down.
Okay, so this is really the critical piece to understand. When rates spiked back in 23 and 24, clients moved cash out of those low-yield sweep accounts into money markets.
The cash sorting phenomena.
Exactly. So Schwab lost that super cheap funding source, which is essentially their inventory, and they had to go borrow from the Federal Home Loan Bank just to maintain liquidity.
Which just crushed their margins, right? It's expensive to run a bank when you're borrowing at 5.5% to hold assets that might only be yielding 4%.
It's a negative carry. It just compressed their net interest margin, their NIM. But what this report shows is that they have effectively paid off that credit card.
Okay.
They reduced that high-cost supplemental funding all the way down to just $5 billion.
And that's normal.
That's what they consider the low end of their business-as-usual range. So, yeah, normal.
So they've swapped that expensive external debt for cheaper client cash again.
Correct. And that swap is pure profit. It drove their pre-tax profit margin up to 50%. That's an 800 basis point expansion.
Right.
That isn't just growth. That is, structural efficiency returning to the model.
And what about the cash sorting boogeyman? This idea that clients would just keep pulling cash out forever to chase higher yields.
The data says it's over. I mean, in December alone, clients brought in over $26 billion in transactional cash. The behavior has normalized.
So the fears were overblown.
It seems so. The duration mismatch fears about their portfolio seem to have been resolved by just waiting it out and letting the cash pile back up.
Which gives them the breathing room to focus on growth. And this is where the report, for me, really diverged from my expectations. When I think of Schwab, historically, I think of a certain demographic.
The retiree, the boomer, the buy and hold crowd.
The country club broker stereotype, exactly.
Yeah.
But the demographics in this 2025 report completely contradict that image.
It is a massive shift. In 2025, nearly 60% of new retail clients were under the age of 40.
60%.
And get this, Gen Z specifically, the demographic everyone says is only on Robinhood or Coinbase, made up nearly 1/3 of all new accounts.
That is a shock. 1 in 3 new Schwab accounts belongs to Gen Z. Is this just brand recognition, or are they actually doing something structurally different to catch them?
It's a mix, I think. It's aggressive social positioning and product fit. They noted they are now the most followed financial services firm on YouTube, and they've pushed really hard into TikTok and Instagram.
So they're meeting them where they are.
Exactly. They're meeting these investors where they consume content, not expecting them to walk into a branch office. But it's not just about getting them in the door, it's about who they're getting. They described a barbell strategy.
Okay, barbell strategy.
Right, and it's smart. The barbell means they're capturing volume on both ends of the spectrum. On one side, you have the beginners, the Gen Z crowd opening their first accounts with small balances. On the other side, they are simultaneously winning the ultra-high net worth flows.
So they aren't cannibalizing their premium business to chase the kids. It's not one or the other.
Exactly, it's additive. And interestingly, the legacy Ameritrade client base, which, was the source of some friction during the merger, that's stabilized.
And that group is crucial. They're the active traders. They generate transaction volume.
Right. And they are now net positive for asset flows. They're staying, and they're using the platform's other tools, like lending and wealth solutions.
Which leads us directly into this trifecta strategy Worcester outlined.
Wealth, banking, and trading.
Let's break that down, because this seems like the engine for the next decade. The wealth piece feels like the holy grail here, moving people from do-it-yourself to do-it-for-me.
That is where the sticky revenue lives. If you're just a broker, you're a commodity. If you're an advisor, you become a partner. Managed investing net flows grew 36% over 2024.
That's a significant jump in clients basically raising their hands and asking for help.
It is. But the opportunity gap they highlighted was huge. Rick Worcester mentioned that only 5% of their retail households currently use managed investing.
Only 5%.
But, and this is the key stat, 31% of their clients say they are willing to pay for advice.
That is a massive disconnect. You have this huge chunk of your client base essentially saying, I would pay you to help me. And Schwab hasn't closed them yet.
That is the runway they keep talking about. If they can convert even a fraction of that 26% gap, that's billions in recurring fee revenue without needing to bring in a single new client.
It's just cross-selling your existing base.
Right. Exactly. Then you have the banking side. Schwab has been trying to be a bank for a long time, but it feels like the product velocity has finally caught up. They really highlighted pledged asset lines, or PLs.
Right, and balances for those have doubled since 2023.
This is a key tool for retention. For anyone listening who hasn't used one, a PL lets you borrow against your portfolio without selling stocks and triggering a capital gains tax. It's liquidity without liquidation.
It's the buy, borrow, die strategy,
Yeah.
democratized. But the friction used to be so high, I remember taking weeks to get these approved at the old legacy banks.
And that's the operational change. Schwab has reduced the digital cycle time for a PL to about 1 day.
1 day, that fundamentally changes the utility of the product.
It does. If you need cash for a real estate down payment or a tax bill and you can get it from Schwab in 24 hours against your Apple stock, why would you ever go to a traditional bank?
You wouldn't. And more importantly, once you have a loan with them, you're not moving those assets somewhere else. It locks you in.
It deepens the moat.
Yeah.
It turns your assets into collateral.
Okay, so we can't ignore the third leg of this stool, trading. They are still an absolute juggernaut there. Daily average trades hit 8.3 million in Q4.
To give you a sense of scale, Schwab handles about 10% of the total notional trading volume in the United States.
Wow.
1 in every $10 of stock traded touches their pipes.
That is immense market power. And they are finally making the move into crypto spot trading, right?
Yes, confirmed for the first half of 2026, spot Bitcoin and Ethereum. They relate to the party compared to the crypto-native exchanges, but with their scale and that Gen Z inflow we discussed, it's a necessary defensive move.
You can't let those clients leave the ecosystem just to buy some Bitcoin.
Right.
So they have the basics, the demographics, the product trifecta. But the part of this report that I found most intellectually interesting and maybe the most risky is this push into private markets.
Yes. The acquisitions of Forge Global and the stake in Carta.
This feels like they're trying to change the market structure itself.
This is the strategic differentiator. This is Schwab looking at the landscape and saying, the public markets aren't enough anymore.
Okay, explain that logic. Why does a retail investor even need access to private equity?
Well, think about the life cycle of a company today versus, say, 20 years ago. Companies are staying private for much, much longer.
Right.
By the time a company like an Uber or an Airbnb finally IPOs, a huge chunk of the growth, the 100x return phase, has already been captured by venture capitalists and private equity firms in the private rounds.
So the IPO isn't the ground floor anymore. It's basically the exit for the early investors.
Precisely. If you only invest in public markets, you are missing the steepest part of the growth curve. Schwab wants to democratize access to that pre-IPO equity.
So how do Forge and Carta fit together here? What's the ecosystem play?
It's a classic vertical integration. Carta is the infrastructure. They manage the cap tables and stock options for thousands of startups. They know who owns what.
Okay.
And Forge is the marketplace. It's the venue where you can actually trade those private shares.
So Schwab is building the bridge between the two.
Yes. Imagine a scenario where an employee at a hot AI startup wants to sell some stock to buy a house. Schwab, through Carta, knows the shares exist. Through Forge, they provide the marketplace.
And through their massive retail client base, they provide the buyer.
It creates a closed loop. Schwab manages the startup's stock plan, helps the employee get liquidity, and gives the Schwab investor access to a pre-IPO company that they just couldn't get anywhere else.
That is bridging a huge gap. I saw Worcester noted that high net worth clients expect to have about 5% of their portfolio in alts or alternatives.
But right now, less than 40% of the independent advisors on Schwab's platform have any allocation to alts.
It's a supply and demand mismatch.
And one that Schwab is perfectly positioned to solve.
It brings institutional-style investing to the mass affluent. And they're even tying this into estate planning with a wealth.com stake. It really feels like they're trying to lock in the client's entire financial life cycle.
From your first trade on TikTok to your complex estate plan involving private equity. The goal is to make it impossible to leave because no one else offers the full suite under one login.
Now, doing all of this requires some serious tech. Managing $11.9 trillion isn't cheap unless you can automate it.
Right.
They dropped some interesting stats on AI efficiency, specifically about cost discipline.
They did. They cited over 220 active AI use cases. But the metric that really matters is the expense on client assets, or EOCA.
This is the unity economics of the business.
Right. And it dropped from 15 basis points in 2020 down to 11 basis points today. That means for every dollar they manage, it costs them significantly less to run the shop.
And that efficiency pays for the new tech, the acquisitions, all of it.
It does. And one of the manifestations of that AI is customer service. They claimed a service center call is answered in less than 30 seconds.
In a world where phone support is usually a nightmare, getting a human, supported by AI tools in under 30 seconds, is a tangible competitive advantage.
It keeps that premium feel even as they scale to the mass market.
I want to pivot to a specific moment in the Q&A that I thought was very, very telling about their culture. Someone asked Rick Worcester about prediction markets.
Ah, yes. The Kalshi or polymarket style betting on elections or Fed rates, it's gotten very trendy.
And this was a defining moment for the brand, in my opinion. Worcester didn't mince words. He drew a pretty hard line.
He did. He distinguished between hedging, using prediction markets to protect a portfolio against inflation, which is legitimate finance and sports betting. He basically said, we do wealth creation, we don't do gambling.
The quote he used about the win rates was just brutal. He noted that less than 5% of clients who use sports betting apps leave with more money than they put in.
It was a subtle but very sharp dig at competitors like Robinhood or DraftKings, who are maybe blurring those lines a bit.
He's positioning Schwab as the adult in the room.
Completely. You can trade crypto, you can buy private equity, but we are not going to help you bet on the Super Bowl. It protects the brand integrity.
Right. If you're trying to win the $5 million RIA account, you just can't look like an online casino.
Exactly.
So let's look ahead to the rest of 2026. The guidance they gave is pretty bullish. They're targeting revenue growth of 9.5% to 10.5%.
Double-digit revenue growth. And crucially, they're keeping expense growth lower mid-single digits, around 5.5% to 6.5%.
So when revenue grows twice as fast as expenses, you get massive operating leverage.
Which brings the EPS target to a range of $5.70 to $5.80. That implies growth in the upper teens on top of the record year they just had.
But here's the variable, the Fed.
The macro assumption is always the wild card, isn't it?
Their baseline scenario assumes the Fed cuts rates by 225 basis points by the end of 2026. That takes the benchmark rate down to about 3.25%.
Which seems reasonable given the current inflation data.
But what if we hit a hard landing? What if rates crash all the way down to 2%?
Well, this is where their sensitivity analysis comes in. In the past, plummeting rates would have just crushed Schwab's earnings because of that revenue squeeze we talked about.
Right.
But they've implemented hedging strategies this time. They've effectively bought insurance. They have income hedges against their margin loan book.
So they're protected on the downside.
Mm-hmm. So even if rates drop to 2%, which implies a pretty bad recessionary environment, they still project at least 10% earnings growth. They've insulated the P&L.
That is the sign of a mature management team. They learned the painful lesson from the 2023 squeeze and basically fixed the roof while the sun was shining in 2025.
They are ready for the rain in 2026, if it comes.
So, to wrap this all up, Schwab has transitioned from a defensive posture plugging holes, managing cash sorting, integrating Ameritrade, to a fully offensive stance.
Yeah.
They're capturing the youth, they're locking in the wealthy, and they're expanding the product shelf into some really interesting areas like private equity.
It's a very impressive pivot. They managed to modernize a 60-year-old firm without alienating the core client base that built it in the first place.
Which leaves us with a final thought for you, the listener. We talk about the Forge and Carta deals. Schwab is betting big that the line between public and private markets is blurring.
That is the key takeaway, Fernie. If this trend of companies staying private longer is permanent, then the very definition of a diversified portfolio has to change.
Right. Is the standard 60-40 portfolio of public stocks and bonds becoming, well, obsolete?
Yeah.
If the best returns are happening behind closed doors, do you need a portfolio that includes pre-IPO access just to keep up with the market average?
As Schwab rolls these products out in 2026, that is the question every retail investor needs to ask themselves. Is your portfolio built for the public markets of 2010 or the hybrid markets of 2030?
A heavy question to end on. Thanks for listening to this deep dive into Charles Schwab's 2025 results. We'll catch you on the next one.
Goodbye, everyone.